Hey there, my name's Justin, and for those of you who don't know me, I paid off over $90,000 in debt while living in one of the most expensive cities in the United States and only making an average salary. I'm now trying to spread the knowledge that I learned along the way to try and help as many people as possible. Today, I'm talking about credit cards and two of the big mistakes I see a lot of people make. The first one is keeping a balance on their credit cards. Credit cards are one of the huge middle class killers where when people are really grinding and living paycheck to paycheck and really struggling, it's usually because of their debt is one of the things holding them back. And credit cards is one of the worst types of debt you can have. And that's usually due to the interest rates that you have on your card. You can easily get above 15% interest on your debt with a credit card. You can, depending on your credit, go over 20% as well. It gets really, really bad. And a lot of people keep a balance on their cards. And without knowing your specific situation, the chance that your credit card debt is some of the worst that you have and should be a financial priority for you is pretty high. There's there are other situations you get into that might be a higher priority, but just in general, without looking at anything, your credit card debt is probably your highest priority of something you want to tackle to get rid of. And the problem with credit cards is a lot of people will set an auto payment so that the minimum payment or maybe minimum payment plus $20 or something will go through at the end of the month. And that's automatic, and so they're not really thinking about it. It's just, it happens, it comes out of their bank account. It's not something that they're actively thinking about a lot. And that can be bad because you're not thinking about it. It's not a priority. Like when you have credit card debt, it's such a big deal. It's such a drain on your finances that you need to be adamant about getting rid of it as quick as possible. If you think about when people talk about the stock market and its average yearly returns over the long run is 10%. That's a 10% gain on average per year in the long run. And everyone always mentions that as such a positive thing. And if you think about that in the reverse with credit cards, your credit card debt, it's typically over 20%. That's double what people are talking about when they talk about the positive percentage on the stock market. And people revere the stock market as an investment opportunity. And they're talking about 10%. And you, meanwhile, have this debt that's just sitting there on a credit card that's often double that percentage per year. And it's just draining on and draining on you to the extent where the stuff that you initially purchased or paid for to accumulate that debt, you're paying much more than if you had just paid for it outright. So if you had a $50 purchase, because it's been sitting on your credit card and you're not paying it off right away and it's accruing this interest, that $50 purchase isn't really a $50 purchase. It's like a $55 purchase or a $60 purchase or $65, depending on how long you let it sit there and the interest is accumulating. And so leaving a balance on your card is such a drain on your money that you've worked for that it has to be a huge priority for you to get rid of that. People have other forms of debt. Usually a lot of people have student loans. Well, and the percentages on those are usually much lower than your credit cards. So that credit cards should be a huge, huge priority. You never want to keep a balance on that. You're playing right into their hands. Credit cards, they make some profit through transactions because they charge fees to businesses when you run your card. But the majority of the money that they make, that the profit in like billions of dollars that these companies are making, it's from people like you that have money just sitting on their card and it's accruing interest. That's their money maker. And even if you are getting benefits from your card, whether it's cash back or air miles or whatever, those benefits are such a small bonus compared to what you're paying in interest. That's why they give you these benefits, is because they want you to spend on the card, and they're hoping that eventually you're going to leave a balance on there and then they'll make it back. So you should absolutely use credit cards. I use credit cards as much as possible. I want as much of my spending to be on credit cards as possible, so I can accrue and get those add-ons. I can get that cash back for things that I was going to spend money on anyways. But you have to pay the balance off. You have to do your highest priority needs to be to get that to zero and then keep it at zero. And so as you spend and use your card every month, you're paying it off before the interest accrues. If you pay off whatever the balance is on your credit card, you won't ever pay interest. And then that's when the benefits of a credit card really come in. The other big mistake I see with credit cards is when people use it as a replacement for an emergency fund. And this is situations where you may have a bank account, but you don't have any savings really there. So if something comes up that's unexpected, that you weren't really planning for, people will use their credit card as that cushion. And so say a $500 purchase comes up, car maintenance, something that you weren't expecting, a lot of people will use their credit card. And then it sits on there, and then they go and they spend it, they pay it down as quick as they can. And the problem with this is very similar to keeping the balance on your credit card in general, is that $500 emergency is now worse. It is more than $500. Because the money that you're sitting on there, and it's accruing interest as you're trying to pay it off as quick as you can, you've now made a $500 situation into a $550, $600 situation, depending on how long it takes you to pay it off. Instead, if you actually had some savings and you had even just a small emergency fund starting out, now when that situation comes up and you need $500, if you have that money in savings already, you can then just pay it. And then that $500 situation, it's only $500. You're not paying this interest, this extra tax on top of it, where you have an emergency that is literally worse because of the fact that you don't have an emergency fund for it, and you're paying the interest for these credit cards. And I see a lot of people will use that credit card as their safety net. The credit card should never be your safety net, and you never want to leave any balance on it whatsoever. It should be used as a tool so that you can gain these bonuses and you get a little bit extra for purchases you are already going to make. But it can't be a replacement for your emergency fund. In the long run, that extra interest, you're just hurting yourself more for these situations that are coming up. I hope this helps. If you have any questions, feel free to leave them below and I'll respond. Otherwise, I'll see you soon.